Hi, today's video will be about one of the main cognitive bias that influence investors. It is the loss aversion bias. I hope that you find the information useful, and if you like the channel, please don't hesitate to subscribe. Before we start, let's just have one question and remember the answer for later on in the video. You could choose between losing $50 for sure or having a 25% chance of losing $200. Which would you choose? Loss aversion was a term proposed by Kahneman and Tversky in their research. The basic definition is that response to losses are stronger than responses to a corresponding gain. So in other words, people feel the pain of a loss more strongly than the joy of a gain of equivalent amount. So if you can play a toss of coin, and if it's tails, you lose £100. If heads, you win £150. Would you accept to play? Most respondents disliked the gamble, even though probabilistically the gamble has a positive value. And the reason for that is that the fear of losing 100 is much stronger than the joy of winning 150. In order to take the gamble, most respondents needed £200 or more. That's a loss aversion ratio of 2. That means that these people needed the gain to be twice as much as the loss. So let's increase the stakes. So although you've seen the theory, try to think on how you would react in real life. If now on tail you were to lose £500, what would you need to have on the win side for you to play? Obviously, we went through a version of this just now, but if you truly put your mind in the situation and think about where your instincts will guide you. So if your response is £500, then you are indifferent to loss. If it's more than £500, then you are loss averse. And if it's less than £500, then you seek risk. So closely related to loss aversion is the endowment effect. And the endowment effect is basically when people assign more value to an item when they own it. So when they start owning an item, all of a sudden they overvalue it. So if you think of a $5 mug, people would be willing to pay $5 for that mug. But once they own the mug, they wouldn't want to part for it for less than, say, $10. That's the endowment effect. Is all of a sudden the value of the item increases once you own it. And the main explanation for that is loss aversion. Once you own the item, losing it has a stronger feeling. You're parting with that item, and so you want to be compensated more for losing that item. And then that's where you have basically two viewpoints for the same item. If you don't own it, you see it as a $5 item, but when you own it, you see it as a $10 item. That's the endowment effect. So with regards to investing, loss aversion has profound implications. One of those implications is that people who have a strong loss aversion might tend to be extremely cautious with their capital and their investment, and so they will look at taking as little risk as possible. As a result, they might be missing out on opportunities simply because they would try to preserve the capital at all cost. And if you were to put all that money in a savings account over a period of 10 or 15 years, your performance will be very different to having invested that in stocks or bonds or a mix. So the loss aversion might push an investor to miss potential investment opportunities. Another strong implication of loss aversion is that people tend to stick and hold on to the losers. So if you have a stock of portfolio, you might tend to hold on to the losers in the hope that they will regain in value. For example, if you have a portfolio with only 2 investments and one of the investment is down 50%, the other investment has a gain of 50%. Now, if you had to sell one of those investments, if you need some money and had to sell one of those investments, a loss averse person will very likely sell the winning investment, pocket a gain, recognize a gain. And the reason for that is if you sell the losing investment, you're actually crystallizing, you're realizing a loss. But if you haven't sold, you haven't recognized that loss, you still have that hope of a recovery. And sometimes this can be misguided and push investors to hold on to losing investment for much longer than they should. And this can also link strongly with the endowment effect that we discussed earlier. So when people start to own something, then parting with it becomes a bit more difficult. And so they might hold on to some asset that no longer serve their best interests simply because of that effect. Conversely, loss aversion can push investors to focus too much on short-term fluctuations. For example, if you make an investment and you start to look at it every day and, oh my God, it has dropped 5%, and you sell it, that's a loss aversion. And so you might be ending up selling investments a bit too quickly without giving them time to perform. And that's different to what we just spoke about, where you hold on to losers for too long, where you get emotionally attached. In this example here, you get very averse to the loss and you don't want to take any more losses. So the bottom line here is that the loss aversion can have a different effect on people, but the bottom line is that your decision becomes emotional rather than rational. And that's the impact here of loss aversion. Likewise, loss aversion might push some investors to take profit too quickly. Say if the investment has gone up 15%, you might be tempted to take profit and avoid that. Perhaps it might go back down and you make some losses. But taking the profit too quickly means that you may not benefit from further upside on the investment. And again, if that's based on an emotional decision, it may not be as appropriate for the investor. The path that takes you to an outcome can change your view on what failure and success is. So you could be winning $100 and be sad, or you could be losing $100 and be happy. So let's say you go to the casino and in the first half an hour you win $1,000. Then in the next 30 minutes you lose $900. So you still have $100 left. Chances are that you will feel happier or better if instead you had lost $1,000 in the first 30 minutes and then won back 900 in the next 30 minutes. So overall you'll be down $100. People may not attribute the same value to their money. In the first scenario, you had a large gain and ended up losing most of it. Essentially, you might see it as being down $900. In the second scenario, you were losing $1,000 and worked your way back up to reduce that loss to just $100. So you might see that as a win or a better situation. There's an element of subjective value. People may not look at it as a $100 loss on its own. They will just compare it to the situation they were just before that. They were down $1,000 and then they're down only $100. Comparatively, that's a much better outcome. Likewise, with the gain, they might not see it as just a $100 gain overall. They might think that actually I was up $1,000 and I'm only up $100. And so here, by winning or losing money first, you are shifting your reference point, and that influences how you feel with the ultimate outcome. And let's take a look at an example with stock. So if you buy $1,000 of Apple shares, and next week they are worth $1,500, then the following week they are worth $1,000 and you sell. You might not feel very good about that. But if on the other hand, next week they're worth only $500 and the following week they're back to $1,000 and you sell, you might feel better on this part. And in both cases you made no profit and no loss. But in the first case you might be sad because you could have made $500 of profit. Whereas in second case you might be happy because you were down $500 and you managed to recover all your money. And so in some instances, how you get to the end result matters more than the actual outcome in making you sad or happy. So what can you do about it? Well, first of all, it's good to be aware of the loss aversion bias, whether you have it or not. It's good to be aware of what it is and how it can impact your decision. Then when you make a decision, you should take that into consideration and try to take a step back and think of whether is this decision the result of an impulse or of a rational decision on my end. If you made an investment plan or a strategy, then you can try to assess whether that decision fit within that plan or strategy. And if it does not fit, perhaps that might indicate that it is the result of an impulse rather than the result of a rational decision-making process. Before making an investment, you could also have some rules. For example, I'm not going to sell it unless it loses 20% of its value, or I'm not going to take the profit unless it makes a profit of at least 50%. And so as long as the performance is within these bands, you don't touch it. And that might help you get away from the impulse, as long as you think about the whole entry and exit strategy before you go into the investment. Another good idea might be to pay a bit less attention to media and things like business and money channels. That's because those channels can feel quite dramatic and the action can feel very fast-paced, and that might perhaps encourage you into having more of those impulses. So perhaps it's a good idea to also take a step back and just stick with your initial plan rather than looking at all the various short-term news and micro variations in your investment. And so one last piece. If there is 25% chance that you lose $200, but you could prevent that by buying insurance for $50, would you want the insurance? So that's what happens usually when you have like phone insurance or all these types of things. 65% of the respondents say yes, that they would buy the insurance. And that happens when you buy a lot of electronics and all these things. Now, if you remember the question at the beginning of the video, which would you choose? Lose $50 for sure or risk a 25% chance of losing $200? So what was your answer? So in the survey, the same respondent, 80% decided to take the risk of losing $200. And both questions are basically the same. And the reason for the difference is because one of the questions is framed as a loss, you're losing $50 for sure, while the other one is framed as you're buying insurance. And so this is a sign of loss aversion. People will choose the other option rather than losing $50 for sure. But if it's an insurance, then psychologically it acts differently. You're just buying something, you're purchasing protection. So it feels different than designating it as a loss. Thank you for watching. I hope that you found the information useful. And if you like the channel, please don't hesitate to subscribe.